Preparing for a Rowe Price interview questions and answers interview? You've reached Candy Mentor, and this video is for you. We'll walk through 20 key questions you're likely to face. For each question you'll see a sample answer followed by the key points to cover. Subscribe, like, and share, and drop a topic request in the comments. Question 1. Why do you want to work at Rowe Price? I am attracted to Rowe Price because its long-term, research-driven investment philosophy matches how I approach problems, understand the fundamentals, challenge assumptions, and avoid short-term noise. The firm's strong client orientation and global platform also appeal to me. I would value working with professionals who connect investment decisions to client outcomes, while contributing my analytical and collaborative skills. This role is especially attractive because it offers meaningful exposure to a respected asset manager and a disciplined operating environment. While answering, focus on Rowe Price's active investment heritage, long-term orientation, research culture, client focus, and how those qualities connect specifically to your skills, experience, and career goals. Question 2. What do you know about Rowe Price's business? Rowe Price is a global asset manager offering strategies across equities, fixed income, multi-asset, alternatives, and related investment solutions. It serves individual, intermediary, institutional, and retirement clients. The firm's identity is closely associated with active management, fundamental research, and long-term investing. Its business depends on delivering competitive risk-adjusted performance, retaining client assets, and operating efficiently. I also understand that scale, distribution, technology, regulatory discipline, and strong client relationships are essential to sustaining that model. Make sure to cover Rowe Price's asset management model, investment products, institutional and intermediary clients, retirement presence, global capabilities, and the importance of investment performance, risk management, and client service. Question 3. Why asset management rather than investment banking or private equity? Asset management appeals to me because it combines analytical depth with an ongoing responsibility for client outcomes. Unlike transaction-focused environments, the work requires forming investment views, monitoring risk, and adapting as information changes over time. Rowe Price is particularly compelling because active research and long-term thinking are central to its identity. I enjoy evaluating businesses and markets, but I also value the accountability of managing capital for clients whose retirement, savings, or institutional objectives depend on sound decisions. In your answer, compare the business models thoughtfully, emphasize long-term ownership and research, and explain why recurring client relationships, investment judgment, and portfolio outcomes genuinely motivate you. Question 4. How would you explain Rowe Price's active management philosophy? Active management means using research and judgment to construct portfolios that differ meaningfully from a benchmark when the evidence supports doing so. At Rowe Price, that would involve fundamental analysis, collaboration across specialists, disciplined portfolio construction, and continuous risk monitoring. The objective is not to trade constantly or outperform every period. It is to create durable value over an appropriate horizon. Success requires a differentiated thesis, careful sizing, and honest evaluation of whether decisions actually added value. Be sure to mention fundamental research, differentiated views, security selection, portfolio construction, risk awareness, long-term horizons, and the fact that active management must justify fees through value added. Question 5. Tell me about a time you demonstrated integrity. During a reporting project, I noticed that an input had been copied from an outdated file, which understated a key expense line. The deadline was close, and correcting it required revisiting several schedules. I raised the issue immediately, documented the source, rebuilt the affected calculations, and explained the impact to my manager. We delivered slightly later but with accurate information and clear audit support. That experience reinforced that transparency matters more than avoiding short-term discomfort, especially when decisions rely on the analysis. Use a specific situation, explain the pressure or conflict, describe the action you personally took, and quantify the outcome where possible. Connect integrity to fiduciary responsibility and accurate reporting. Question 6. Describe a time you disagreed with a teammate or senior colleague. On a forecasting assignment, a teammate favored extrapolating historical growth, while I believed a customer concentration issue made that assumption too aggressive. I first asked questions to understand the model, then presented a sensitivity analysis showing how the concentration affected outcomes. We agreed to use a base case, downside case, and explicit monitoring trigger rather than argue for one permanent assumption. The final model was more useful because it preserved the original insight while making the risk visible to decision makers. Focus on respectful challenge, evidence-based communication, listening, compromise, and the final result. Demonstrate that disagreement improves decisions rather than becoming personal or slowing execution. Question 7. How do you prioritize when several deadlines compete? I start by ranking tasks according to client impact, regulatory or reporting risk, hard deadlines, and dependencies. I then break each deliverable into milestones, reserve time for review, and communicate conflicts early rather than letting them become surprises. For example, during a period-end cycle, I completed a data validation affecting multiple reports before a lower-risk presentation update. I also documented outstanding items and confirmed priorities with my manager. That approach keeps execution transparent and protects quality under pressure. Mention materiality, client or regulatory impact, dependencies, time estimates, communication, and escalation. Show that you maintain quality while reprioritizing rather than simply working longer hours without a plan. Question 8. What makes a good investment analyst or asset management professional? A strong asset management professional combines curiosity with disciplined skepticism. They understand financial statements, industry structure, valuation, and portfolio risk, but they also recognize what they do not know. Independent thinking matters because differentiated conclusions can create value, while humility matters because markets expose weak assumptions quickly. I would add clear communication, reliable execution, and willingness to collaborate. The best professionals turn complex information into an actionable view and continuously test whether that view still deserves capital. In your answer, discuss curiosity, analytical rigor, independent thinking, humility, communication, risk awareness, attention to detail, and the ability to revise a view when facts change. Question 9. How would you evaluate a company's financial health? I would begin with the income statement to understand growth, margins, and earnings quality, then reconcile those results to operating cash flow and free cash flow. Next, I would assess leverage, liquidity, debt maturities, working capital, and returns on invested capital. I would compare trends with peers and investigate unusual accounting items or one-time benefits. Finally, I would evaluate management, competitive advantages, and valuation. Financial health is not just profitability, it is the durability of cash generation relative to risk and price. Cover revenue quality, margins, cash flow, balance sheet strength, returns on capital, liquidity, industry position, management quality, accounting risks, and valuation. Explain how you would compare trends and peers. Question 10. Walk me through how you would value a company. I would first understand the business model, competitive position, growth drivers, margins, reinvestment needs, and risks. For a DCF, I would forecast unlevered free cash flow, select a defensible discount rate, estimate terminal value, and test sensitivities around growth and margins. I would triangulate that result with trading comparables and, where useful, precedent transactions. The final conclusion should explain the assumptions driving value, the downside risks, and whether the current price offers a sufficient margin of safety. Make sure to cover business understanding, forecast drivers, DCF mechanics, comparable companies, transaction or asset-based perspectives where relevant, sensitivity analysis, and valuation judgment rather than false precision. Question 11. How do interest rates affect bonds and fixed income portfolios? Bond prices generally move inversely to yields, so rising rates typically reduce the value of existing bonds. Duration provides a first approximation of that sensitivity, while convexity improves the estimate for larger moves. I would also separate changes in government yields from credit spread movements, because a company bond can weaken even when rates fall if its perceived default risk rises. Portfolio impact depends on maturity, duration, curve positioning, security structure, and reinvestment opportunities, not simply on the headline rate move. Discuss the inverse price-yield relationship, duration, convexity, credit spreads, curve shape, reinvestment effects, and why portfolio impact depends on maturity, structure, and security-specific risks. Question 12. What is the difference between active risk and tracking error? Tracking error is the volatility of a portfolio's return relative to its benchmark, usually measured as the standard deviation of active returns. Active risk is broader and can include the possibility of underperformance from factor, security, sector, liquidity, or implementation exposures. A portfolio may have modest tracking error but still carry meaningful hidden risks if the benchmark is poorly chosen. I would use both measures alongside attribution, stress testing, and portfolio objectives to determine whether active positions are intentional and appropriately sized. Explain tracking error as variability of active returns, distinguish it from active risk in the broader sense, and connect both concepts to benchmark choice, portfolio construction, conviction, and risk budgeting. Question 13. How would you assess whether an investment thesis is working? I would write down the thesis before investing, including the earnings drivers, expected milestones, risks, valuation, and time horizon. I would then monitor operating evidence rather than simply the share price, revenue quality, margins, cash conversion, competitive developments, and management execution. If results differ, I would determine whether the thesis is temporarily delayed or fundamentally broken. That distinction matters. I would resize or exit when evidence invalidates the thesis, not merely because volatility creates short-term discomfort. Focus on the original thesis, measurable operating milestones, valuation assumptions, catalysts, disconfirming evidence, time horizon, and a predefined process for holding, resizing, or exiting the position. Question 14. Tell me about a time you used data to make a recommendation. I analyzed monthly operating data to understand why a business unit was missing its margin target. After cleaning inconsistent classifications, I separated volume, pricing, product mix, and cost effects. The analysis showed that the headline issue was not broad cost inflation but a shift toward lower margin products. I recommended revising the product mix dashboard and adding a pricing review by customer segment. Management adopted the changes, which improved visibility and helped focus corrective action on the actual driver rather than the misleading aggregate trend. Describe the question, data sources, analytical method, quality checks, insight, recommendation, and measurable result. Highlight judgment and communication rather than presenting analysis as an end in itself. Question 15. How would you handle a material error in a fund report or client deliverable? I would first confirm the error, preserve the evidence, and determine whether the report had already been distributed. I would notify my manager and the relevant control, operations, compliance, or client service teams promptly, explaining the known facts without speculation. We would assess materiality, correct the underlying data and affected outputs, and communicate transparently with clients if required. Finally, I would document the root cause and strengthen the control, such as an independent review or automated reconciliation, so the issue does not repeat. Mention stopping distribution if possible, validating the error, notifying the appropriate stakeholders, assessing materiality, correcting records and outputs, documenting root cause, and implementing controls to prevent recurrence. Question 16. Explain the relationship between net asset value and fund performance. NAV equals a fund's assets minus liabilities divided by the number of shares outstanding. It changes because portfolio holdings are revalued, income and expenses accrue, and investors subscribe or redeem. A distribution can reduce NAV even though investors received value, so performance should include reinvested distributions and be measured on a total return basis. Accurate pricing, corporate actions, accruals, and share activity are therefore essential. NAV is the foundation for transactions and reporting, but it is not by itself the complete performance measure. Cover NAV calculation: assets minus liabilities, subscriptions and redemptions, income and valuation changes, distributions, total return, pricing controls, and why performance cannot be inferred from NAV movement alone. Question 17. What accounting issues are particularly important in an asset management business? Key issues include valuing investments appropriately, recording purchases and sales, accruing management and performance fees, recognizing expenses, and handling foreign exchange and corporate actions. The fair value hierarchy and valuation policies are important when observable market prices are unavailable. Asset managers also need strong controls over NAV, client reporting, revenue recognition, and regulatory disclosures. I would pay particular attention to cutoff, reconciliations, independent price verification, and documentation, because small processing errors can affect many funds, clients, and downstream reports. Discuss investment valuation, fee revenue, accrued expenses, fair value hierarchy, foreign exchange, securities transactions, consolidation, financial reporting controls, and the importance of accurate books supporting NAV and client reporting. Question 18. How would you investigate a portfolio reconciliation break? I would first classify the break by security, cash, position, price, trade date, settlement date, or corporate action. Then I would compare the internal ledger with the custodian or accounting record and trace the relevant trade confirmations, settlement instructions, prices, and accrued income. I would check whether timing explains the difference before assuming an error. For a material or unresolved break, I would escalate promptly, record the investigation, correct the source data, and confirm that the reconciliation clears after remediation. Lay out a structured process. Define the break, compare positions and cash, trace trade and settlement data, review corporate actions and prices, identify root cause, escalate material items, and document resolution. Question 19. How do you communicate a complex investment or financial issue to a non-technical stakeholder? I begin with the conclusion and why it matters, then explain only the mechanics needed for the audience to make a decision. For example, instead of leading with duration statistics, I would say that a portfolio is sensitive to rate changes and quantify the approximate impact under defined scenarios. I separate facts, assumptions, and judgment, use a simple visual where helpful, and invite questions. I also confirm the agreed action and document any unresolved uncertainty so communication supports execution. Emphasize starting with the decision required, using plain language, separating facts from assumptions, quantifying impact, avoiding unnecessary jargon, checking understanding, and providing clear next steps. Question 20. What questions would you ask us at the end of a Rowe Price interview? I would ask how success is measured during the first 6 to 12 months, which responsibilities require the fastest learning, and how the team collaborates with investment, operations, technology, risk, and client-facing groups. I would also ask how professionals receive feedback and develop broader perspective across Rowe Price. Finally, I would be interested in the business priorities most likely to affect this role, such as evolving client needs, technology, product development, or market structure. Those questions would help me understand expectations and contribution. Ask thoughtful questions about role expectations, team collaboration, development, investment or operational decision-making, client impact, success measures, and current industry priorities. Avoid questions answered easily on the company website. If you are still with us, congratulations. You are much ahead of the rest and serious about preparing for your interview. We hope we were able to add value to your preparation and create some helpful content. Do not forget to like and share this video. Your small act can do great things for us.